One of the biggest 0-day to expiration options positions has just been placed. Who could it be? Hello, ladies and gentlemen, and welcome back. In today's video, we talk about the data driving the markets right now and the options market. We discuss specifically the base that's forming here, the potential of a rally into a very good fill gap zone, and also what could happen for the beginning into the late March period. Let's get into the data and everything that's moving the markets right now. Well, welcome back everyone to the Daily Show. And of course, let's get into it by beginning with the news, the big lead indicators, the macro data, and of course, then we'll finish up with the hottest charts and the key levels that we should be looking at. It's an exciting one because there's so many great setups that are about to occur. Let's talk about short-dated options. We're all aware of them by now, and if you're not, I'm not sure where you've been at the back end of 2022 into 23. 0 days to expiry, short-dated options. They're being filled, and they're being filled in huge zones. Basically, on the Thursday position, we saw a massive trade, and that trade was 26,000 Feb 23 put options on the S&P 500 E-minis, all at the 4,000 level. It can really show you why there was a bit of covering probably through the session and why we ended up moving lower. But by the end of the day, Wall Street didn't want to pay and markets moved straight back up to above that 4K zone. What does this mean in the charts? We'll look at those a little bit later in today's show. But 0 day to expiry options are here to stay, and it's going to become one of the biggest talking points, I believe, of the next 2 years. On this channel, we'll be following everything about that. So make sure to subscribe because we're going to start looking at these options positions moving forward. Let's talk about spreads as well. Now, we know that this year is very tough to pick. 2023 actually has the largest spread between bullish and bearish analysts for the year-end S&P 500 targets for a very long time. In fact, it's the highest we have here in the record. 35% was getting close during the 2009 period. In 2023, everyone's even more divided. And it shows you that it's a time where kangaroo markets could ensue. Effectively, we've got markets that are going up and down and all around. Being nimble and fast is going to be one of the biggest things that you can look at. So let's bring up a couple of charts that we shared over at FX Evolution. Click on the links down below if you're interested in some of these things. The first one is something we've been tracking for a while. We did this a lot in 2022. And at the moment, of course, we've brought it up recently as well. And that's smart money, inverted commas, versus dumb money. This is just a flow chart. And what it shows you is often when dumb money's kind of peaking and getting up near this 0.7, we need to be a little bit conflicted or concerned about markets. Now, it doesn't individually change every stock. It's more for the S&P 500 as a whole. But we've seen since the dipping, of course, smart money starting to flow in. That's normal. Every single time we see dips, it tends to be that the smart money tends to be buying in. And when we're getting those drop-offs, that's when they're hitting their crescendos. They're basically hitting their peaking of purchasing power. So we kind of want to go with smart money as much as we can. But of course, in 2023, it has been a little bit different, especially for a few stocks. So what about data? What's the data telling us right now? Well, we talked about this in February. We basically discussed the idea that the middle of February into the back end of Feb and the start of March is usually a negative time for markets. In fact, this whole period is usually where you get that kind of declining market, where you have a decline, rallies that are met by, let's call it, sell-offs. Now, does that mean that we're going to have an epic back-end March, April? Well, it is actually quite possible, and it depends where the stock markets end up, but we'll be talking about that later on today's video. Let's get into some other charts right now. Global liquidity. This is probably the biggest thing to blame for why markets are up right now. Basically, if we take the G6 liquidity, Fed, ECB, Bank of England, Bank of Japan, Canada, and of course China, we can see that financial, let's say, conditions have not exactly continued to tighten. This is a chart that we'll be watching. Now, if global liquidity has bounced and we're not going to see this drop back off, it's going to be hard for stocks to fall off. We know that markets overall are based on basically central bank liquidity nowadays. They're not based on much else. So this is something that we'll be watching and of course we'll be on top of. Bear markets, I just want to discuss this concept. If we are going into recession, generally they will bottom straight after the call of recession or just before. So just remember, by the time you hear a word recession in the markets, it's generally already too late to be buying that bottom. Keep that in the back of your mind. And at this point, we obviously haven't even seen an official recession yet. So this is something that may happen in the back end of 2023 into 2024 is highly speculated at this point. These are some of the old history points. Pause the video if you're interested in it. We've talked about that quite a lot, and we will bring it back up from time to time. So what are the markets doing? Well, they're following the no recession concept. Now, I've mentioned this many times. The bonds market doesn't tend to agree with the stock market right now. Overall, when I'm looking at the medium to long term, I tend to realistically put most of the weight in bonds. But the problem with markets is it's all about being patient. Now, timing is everything. I think we're all aware of that. So if you believe the bonds market is correct, remember, bonds are typically 12 to even 18 months or further 24 months early when they call recessions. At the moment, the market's following the no recession path, mostly due to, I believe, a lot of the liquidity that's coming in from central banks, even though they claim it's tightening. Now, if we're not following the, let's call it, recovery path, and we do have a recession, markets tend to go lower and worse. So this is something to keep in the back of your mind for potentially later on this year, especially as we see earnings go through some of the big problems. Look for unemployment to also start to actually rise. That's not something we've seen in the US, but do remember we've got new jobs numbers coming out in only a few weeks. So this is another one to think about as well. When the Fed pivots and we have an inverted bond yield, remember markets tend to go down. At the moment, we haven't got a Fed pivoting. We've just got a rising rate. And that actually can bring bulls back into the market. So even if we go weakish in March and we start to fall down to some of the key zones we'll discuss today, there's still a good chance that rallies could ensue. Now, why are rallies even going to happen right now? Well, a lot of it has to do with 1/3 of the US economy. When you think about it, US consumers are not slowing down. They're spending just like they always were ever since really 2020. It's the new norm. Everybody feels like they're entitled to obviously buy everything. And I think you out there would know, all of us know, somebody that's buying stuff probably beyond their means. Now, it's being represented in something we mentioned in the previous video, which is, of course, US credit card balances, as they are increasing to new highs. And what this basically is showing that at some point, somebody's going to have to pay these back. Now, are they going to pay them back at a cheap interest rate? No, it's going to be a more expensive interest rate. So eventually this will hurt the American consumer. It's just that it's lagging more than anyone expected. People are not tightening up. They're just spending and spending and spending, believing that the Fed will pivot, cut rates, and make it cheaper for them to take debt. This could be a big disaster, of course, as it's unlikely to occur. The Fed keeps telling us that it's going to be higher for longer. They're going to kill the inflation, and they're going to have to leave, remember, the terminal rate, which is the highest interest rate we'll look at later on, for longer. And this is something that I think a lot of people in the world are not really understanding. It's going to sit there for as long as needed because they have to do it. They cannot repeat the 1970s mistakes again, and they're not going to. At least that's what they're telling us. We'll find out whether they believe it. So why do we use the data of the seasonality to do with the stock market? Well, one of the reasons was we were at what we call an extreme zone number 1. And that helped us to really define the fact that we'd get this sell-off right now. At the moment, we still think that rallies could be met by sell demand, at least initially. Now, another thing that we see is we tend to see VIX spiking over the Q1 and Q3 periods. So it could be that Q2 actually is bullish for markets because remember, the volatility tends to drop off then. It's like the calm before the storm. It's something we need to keep in the back of our minds. If we move over here to some of the things that we've seen recently as well, we've got lower IV, which is implied volatility that tends to go with the spike zones of the markets. And again, recently we have low IV and we have a pretty extreme market. Obviously, we see those divergences between smart money, dumb money as well, and everything else. But before a market truly sells off, we tend to see flow sector rotation. And what that means is that if you think about big funds, whether it's a 401k fund or just a huge investment fund, they have to be mandated to be invested in the market. They can't just sit in cash all the time. And they tend to show their hand a little bit. And we talk about this on the channel by rotating into defensive style sectors. Now, we haven't seen a huge amount of rotation recently into some of the defensive sectors. However, they've held up better during this last recent kind of sell-off, this 5% sell-off we've seen so far. In the last 24 hours, NVIDIA was the absolute standout. If you mention AI around 90 times, it seems that you do very, very well. And that is the new norm now. It's like lithium stocks a few years ago, 3D printers, marijuana stocks. It doesn't really matter. It just shows you that when the hype's on, it's very difficult to go against it. So semiconductors did the best. We've also got technology, energy, clean energy. They were the ones in the lead. Now, if we go to a 5-day kind of rotation, you'll see that it is actually the staples and the agricultural and the defensives that are sitting up the top. And this is what you usually expect. Now, if we get a rally in markets and the rally brings staples and healthcare and utilities up as well, that's when you can be more sure that the rally is false. And at this stage, we, well, firstly haven't seen a rally in this sell-off so far, but if we do, that's something we're looking for. And it's another one of those confluence storylines that we want to bring in on this channel. Remember, finding as many separate reasons as possible to stack zones is how you build edge in the markets. And that's something that's very important. But it does take patience and the ability to react to those key levels and what's happening. So let's jump into the charts. Let's talk about the volatility right now in markets. And I think it's pretty clear to all of us that volatility has dropped in recent days, hence why the VIX is coming down. Let's move over to the US 2-year. Yields are the most important. Recently, we've seen yields start skyrocketing as inflation concerns come back. Still have the alerts at 4.88. If that happens and markets are rallying, just remember, bad things are going to happen. Eventually, this does come back to hit the markets, and you just need to have a steadfast opinion on in terms of how you're looking at it. What's your timing? What is, more importantly, your plan? And are you ready for the scenarios? If we move to the terminal rates, we can see here 5.3 is now currently where the markets are at. A lot of key economists are starting to move up to 5.75 to 6% as being the Fed terminal rate. But we're basically still sitting at August to September of this year being the highest level that the Fed will get to. The more important thing, though, is that there is almost no chance now that there is a cut in 2023. So what that's telling you is at the moment, the market believes we're going to get to a higher interest rate, we're going to remain there longer, and we may not see an actual Fed pivot to 2024, which is why the chances of US recession this year are declining. This is not our opinion, it's the opinion of the markets, but it's very important that we understand that. So actually this whole talk of Fed pivots, it could be quite a while away. Higher for longer, more kangaroo style markets, and the stats that we're talking about right now actually may not apply for another 6 to 8 months. So this is going to be a bit annoying for a lot of people out there because you're going to look at that and say, I can't wait that long. I want to trade right now. Be nimble and fast and have your plans in place. Also, recognize the risks when it's worth recognizing them. So we talked a lot about treasuries, and treasuries are back down to some pretty critical levels. If you believe we're getting closer to the high of the interest rates, then treasuries are getting closer to a good buy for you. Now remember, people tend to only buy bonds either when they hate them, in terms of this is when bonds tend to do really well. So bonds are universally hated. I remember this back in, I think like 2018, everyone hated bonds. They actually went up pretty well over that period of time. And then they also buy them when they realize they need them. So at the moment, we could be in a chance, if we believe a US recession will come, that bonds will purchase usually before the recession itself. So do remember, if we start to see jobs numbers realistically weakening and we start seeing unemployment spiking up, I wouldn't be surprised at all to see TLT do a little bit better. Let's move over to high yields. Another okay day for high yields. The market stood firm, mostly because of the options. However, the high yields started picking back up. Now, I don't like buying high yields. I think they're called junk for a reason, but we do use this as a bit of an analysis on whether markets are actually really sick or not. Recently, we saw high yields dropping while we were consolidating on the SPY, and it strengthened our case for this current sell-off. If high yields continue to go up, then we believe the markets could rally. And then, of course, we're looking for high yields to drop back off to allow the new level lows, hopefully into March. Let's look at the US dollar. US dollar continues to basically make a higher highs and break through. This has been the trade of the last couple of weeks. A lot of people have been caught off guard on this. I'm not betting against the US dollar for now. I'm just going USD being the great kind of I guess, denominator here when it comes to interest rate hikes. And let's face it, it's better to own cash when interest rates are going up. It's more desired. So we're getting into the critical zones yet, but we're not quite in our green box. We still remain bullish basically on this. And if you look at the 2-hour timeframes, we're basically just making a series of higher lows and higher highs. This is our last demand zone, which is at 103.75. Unless it gets broken below, that we really can't be thinking about the DXY being weak in any way. So still rallies at this stage. That's put some pressure on gold. Gold is continuing its kind of lockstep down. I'm pretty neutral on this pair at the moment. If you're short, I don't really see a reason to be scared. And if you're long, then I don't really see a reason to buy either at this stage. So gold continues to come down. As long as yields keep hiking up, don't expect gold to do incredibly well. It has found some buyers here. Possibly you can set alerts above these critical levels of 1846 like we've been discussing. And there's a chance it could double bottom here, but at this stage, we don't have the evidence to really point towards that. Let's talk about copper now. So we discussed that copper's coming into a period of time it doesn't tend to do well. This is also designed as Dr. Copper. So for anyone that's new, copper effectively is like a kind of like an economic sickness. Now at the moment, it's been rallying. Why? China liquidity. So we've seen the China liquidity story come out. Everyone's now aware that they're injecting money all over the control. So you'd think, well, doesn't that mean copper should go up? Well, yeah, it also already kind of bought up. So it was probably more of a buy the rumor situation. When the CCP basically pivoted and they said, okay, we're opening back up, you kind of knew stimulus was coming. They've got a really big problem in their property market, and it's a big problem. Don't get me wrong. I don't think it fails now. But don't ever forget over the next couple of years that this, at least in my opinion, is one of the leading factors that could take down the world economy in the future. And I believe property in China is a ticking time bomb. Okay, so it's going to be bad. You can't just be giving people 80-plus-year-olds massive loans and doing all of these types of stimulus without there being a serious crack in the back. And remember, when fear starts to spread in that type of market, it could be like what happened to Japan during the 1980s and 90s. And I know we have some Japanese viewers out there. If you want to, you can share, if you're around for those times, what it was like. Because I'll give you a story, and I believe this story is true, that I think it was the Emperor's Palace was worth more than all of the real estate in California during those times at that time. So yeah, it's really amazing how big bubbles can get. I'm not saying it breaks right now, but you need to keep an eye on it. Anyway, back onto the copper story. We rejected the 61.8 retracement. We're looking for new lows here. We really want to be setting alerts basically underneath this. If that happens, then the trade could be on in terms of further on in, from what happens to copper and the weakness. Next stop would be around that 370. So we're watching this as an economic health indicator at the moment. Copper's retraced. It's doing okay, but overall, we're weak on it. We still remain that way. Natural gas coming into a decent time for it. Now, I'll put a warning out there. It's called the Widowmaker for a reason. This thing moves upwards of 10 to even 15% in a day. So you have to be prepared for that. It also is usually a roll future. Now, we just saw the roll, and often rolls can kind of put lows in. So what happens is they kind of squeeze everybody out. The contract expires, the new one rolls over, and then we move up. This is a good positive weekly candle if we can close this way. It basically shows you that this may be the temp bottom. And this is the first time we've seen something positive. Of course, one more day of trade. We'll find out how it works. We'll check it out on the weekend. Just before we keep going, I wanted to check out oil as well. No new low break for oil. So 73.20, we're still stuck within the range. No new updates on that one. Let's move over to Tesla now. Now, Tesla did okay. It was up on the session. Not really exceptional or anything like that. It's stuck in a trading range. A lot of bullish bets above that 210 this week. And the bearish bets sit around that 190, 185. So realistically, it's stuck within a perfect zone to make a lot of money for Wall Street and the composite man and make as little as possible for you, the retail traders. For all of us out there, we just don't get paid, yeah? So you can see here the two kind of main critical kind of high zones, and you can also see the range that we expected the market to stay within. So it's really just working out well for Wall Street at this stage. It's still a bullish trend. There's nothing that's really changed that. We're at in the middle of nowhere land as well if you go back to it. But if we end up hitting into the extreme zone number 2s and the markets start rallying a lot, I think bears will sit in this range. So we want to look at structure quite a lot. At this stage, though, no major moves in these markets. Let's move over to Apple now. A pretty decent day. Came down and tested the lows. We see the long leg doji. We see, of course, the rejection. And it's now above the weekly options expected lows that we put in earlier this week. So it's a nice expiration point for it. I'm still looking towards bullish pressure, hopefully coming back into the stock market here. And you might say, well, Tom, you're such a bear, or you've talked about being bearish. Yeah, but you still need to fill some of these gaps. Otherwise, you're not doing things properly. So you do want to see markets kind of do this. They come up and then they fill some of the gaps and then they come back down. So Apple at the moment showing us some signs of buyers coming back in. Speaking of buyers, the FOMO was out on the AI, and this is probably an options for sure. After hours, we see massive trade. Then we see huge trade through the session. We end up 14% up on NVIDIA. So it got through that tweezer high and it's actually closed the daily here. Now the weekly hasn't closed, but the daily has. Could we be moving to the next zone, which sits at 260 for NVIDIA? Well, it's possible. This thing is blowing out. Basically what's happening here is we're in an extended trend, and we've seen that before. And then it eventually will go bad. Look, it's detaching itself from full fundamentals, and basically this is a hype trade now. And we already knew it was a hype trade before, but when you get involved in these types of things, it's kind of like being involved in GameStop or AMC. If you bet against it, you better have time on your side, and you better be using options and correct risk management. If you're with the trade, well, you better be watching which zones. Now, I've seen everybody writing articles and they're all like, this thing has so much more to run. Now that the moon is on the horizon, everyone's feeling great. And that's the time you need to be most careful. The trend hasn't technically broken yet. We saw the tweezer, which was certainly negative, and obviously my key level here to be watched. But yeah, at the moment, it's bullishing through. We'll see how it closes for the week. Very interesting one. Probably a watch and don't touch unless you're unless you like to live on the wild side. Let's move over to the DAX. And the DAX continues to find bullish pressure. Now, this is going for most of the European markets. And you might say, well, how are they going up so much? Well, it's partly the stocks that are underneath these markets. Remember, it's only 40 stocks. But also, it's because so many people are trying to short it. So in comparison, on CFDs anyway, about 50% of people are long and 50% of people at the moment are short on the S&P 500. So it's a pretty good split. 78% of people are currently short on the DAX and the FTSE and the France 40. So it's very difficult for that market to go down. Now, over in Australia, it's a little bit different story. We're very open to copper weakness. So if you see metals and energy and banks start to suffer, the Australian market will usually suffer. And I don't really change some of my opinions. I still think that even if we bounce, overall, the Australian stock market should be coming back to these 7100s and 7,000 zones. We'll just leave it there. Now let's move over to the big ones, the American market. That's where it's to be. Yeah, we need to be checking this market out. So we know that the Qs versus the SPY are still in our trend line. So that basically means we're not seeing incredible outperformance of the Qs. So we're not sure that we're in a really true rally at this stage. We hit this critical level, which has been a zone that stopped us throughout 2022 and so far in 2023. Remember to have this combo on your charts. It's going to be pretty important to watch. For the US 30, we come back down to kind of like a demand box here. So again, we could see buyers recommit and then possibly sell it back off. We had that trend, that triangle, and it broke to the low side. So at this stage, it looks like rallies could be met by sell demand, which it works into the data for the US 30. When we move over to the Qs, again, expected weekly options low was hit basically within one trading day this week, shorter trading week. And overall, we've found some buyers there. The Q's actually working a little bit nicer than the S&P 500, mostly due to that 0 day to expiry options, I believe. And most likely, I mean, you could make some guesses. I said who's probably doing it. It's probably someone like Carl. So I would guess something like that. You'd probably guess that type of person, considering he was in it only a few weeks ago. And yeah, I'd probably say that would be the most likely person that was doing it. However, it is a guess. We know it's institutional. It's too big not to be. And we'll find out how much this starts to affect these markets, because that was really a huge effect on why the stocks, I believe, weren't able to rally. Huge amounts of hedges had to come in to cover, which means they had to sell the futures off. They sold the futures and they rallied it, and they managed to rally it, obviously, to not pay that particular position. But yeah, we'll find out what happens next. US 100, let's have a look here. Very nice demand zone. We continue to hold it. Look, we believe that this level is pretty damn critical. It doesn't matter whether you're looking at the US 100 NASDAQ or the S&P 500, both zones make sense. And we continue to see buyers. In fact, the US 100 really looks a lot better than the SPY at this stage. But let's move over to the SPY. We see that big rejection into the close. We still haven't closed above the long leg doji, or the doji from the previous session, which is an indecision style candle or equilibrium. And we're looking towards unfilled gaps. So I'm really favoring the concept of markets coming back up, filling the gaps, and then potentially finding sell that pushes us down to 3900s and possibly even the structure down here between 3800 and 3850. Now, I'm sure a lot of you would rejoice if that happened, because you'd be pretty damn happy. Some of you here were going to want 3200s within a few weeks. I'm not sure that's going to happen for you, but I certainly could see these levels being reached. So 3900, 3800, these zones, especially even the gap that sits underneath 3800, which is 3750, these are some critical levels we'll be looking at. So follow us. We'll be continuing to watch this if it starts to play the game that we believe it will. Weekly options expected lows. Well, guess where we're sitting? We're still there. That's why we've got a kind of bullish bias at this level as well. It's a further level of confluence, and we're right on the bottoms there. And then we move over to an interesting story. Now, I saw a few people in our Discord community. Follow the links in the links down below if you're interested in joining. And basically, they were talking about diamond bottom formations or diamond formations. So it's where you get kind of like an expanding market where it's making higher highs and lower lows. And then it basically sticks within this range and eventually breaks out. Now, sometimes these look like actual inverse head and shoulders. I haven't been using too much patterns recently just because I think people can really misconstrue them. So I tend to like to follow on horizontals and key levels to make it simpler for everybody out there. But this is the kind of levels that we're seeing at the moment. Now, I don't think this is drawn perfectly. It probably should be down like that. But basically, the market can remain stabilizing in here. If it does break out to the upward side and kind of breaks through that lowering diamond triangle formation on this side, then you're kind of looking towards bullish pressure. And where do we think the markets can go? Well, it's still these unfilled gaps, this 61.8 retracement, critical level up here. The way I'm liking it at the moment is kind of like breaking up, hitting this zone, finding sellers, rallying once, and then selling off, kind of to take out the stop losses of those sellers. This is just a theory, but it's the leading theory that we have in these markets right now. For bears, what do you want? New lows. If you get underneath our weekly closes down here and specifically target off this 395 level, which we know between 395 and 400 is where all the puts are, which we'll look at in a second, then yeah, maybe you start a scalper, kind of like a real cascade effect on markets. Bear markets or bear starts can be very brutal. We've already seen a pretty significant sell-off. I mean, from up here to down here may not seem like much, but it's 4.6% on the SPY. That's quite a lot. And we haven't really had one retracement yet. So a big retracement would be nice around to there, and then to see sell-offs. There's a lot of unfilled gaps on the way down here for stocks. Generally speaking, markets will go back to kind of beat out that inefficiency, if you want to call it that. Let's move over to the 24th and have a look at some of the options positions. We still know that 395 and 400 have huge amounts of puts on them, and we still know where the calls are. So it's basically best off to move the markets a little bit up for Wall Street. 402 is currently the max pain as of Friday. It's come down quite a lot, but realistically, somewhere trapped within this zone would be good. Then maybe an early rally into the start of next week, and then hopefully a sell-off. Now, we move 1 week ahead in options and we go to the third here. You'll notice that 390 and 392 become the put kind of wall zones. So again, allowing the market to possibly go up and then possibly sell down, suck in some of those calls and then sell down. That's at least the leading theory that we're working with here on the channel at the moment. What about Bitcoin? It's holding its best. I mean, look, it's still where the sellers that are up here in the watch reaction zone, they're doing pretty damn good. They're happy with themselves right now. For you to be, really excited as a buyer, because the trend, the swing at the moment is up, you want this level to be broken and closed above. If it does happen, the next zones are like $30,000 for Bitcoin. This is the next structural zone area. So if you're a bull, you want this level to be broken. Set alerts, you want it closed above, and that should ensure some serious movement. I believe a lot of the Bitcoin rally has been due to Bank of China and what's going on with the massive stimulus. So the stimulus has definitely helped buoy Bitcoin at this point in the cryptos. We're seeing a lot of chatter about it. If stocks start to fail though, expect Bitcoin to also suffer. I mean, that's just the way of the world. At this point though, for bulls, that's all you care about. You just want above this level. You want above this level and you want these lows to ideally hold. If they don't hold, well, the next big kind of buy zone for crypto players would be around that 21,800, 650. Let's move over to the news ahead. We do have one bit of news that could stimulate the markets, and that's going to be core PCE price index. Obviously, the prelim GDP came in at 2.7 down. Look, it doesn't show anything good about the markets, but I don't really think it's going to be a massive effect at the moment. So we're looking for core PCE price index. We'll find out how that affects it 1 hour before the New York Open, 8:30 a.m. As always, if you haven't already, come and follow us over on the other social medias, whether you join our Discord, Twitter, where we post a lot of stuff, or of course, go and get some of our free cheat sheets, which you can sign up here. March will be the first month we put out our data reports as well, which are going to be free. So if you're interested in the data reports, just sign up here and I'll put you in the list. Thanks so much, guys. Have a great day. Subscribe, smash the like button if you enjoyed the video. We'll see you in the next one. Bye for now.